Hi, I'm Dan Keoppel. I'm Executive Director of Strategic Investments or Venture Capital Investments at Verizon. As Jim said, I've been doing that job for about 15 years. Prior to that, doing M&A and business development at, Verizon, Atlantic, 9X, through a bunch of acquisitions and mergers. Prior to that, I was doing M&A at AT&T. Before that, I worked as a CFO of their venture capital organization when I got off the ground. I got my MBA from this august institution back in, I don't even remember, 92, that was it. And prior to that, I graduated from Rutgers with psych and philosophy degrees. So I desperately needed business education. So I have been doing VC, a corporate VC, for 15 years. And today I'm just going to talk a little bit about what the status of the venture industry is like, try and dig in a little bit about what our program is like, and then leave plenty of questions about whatever you guys are interested in talking to. So everything you need to know about venture capital right now you can get from watching television. These shows will describe what we're looking at in the VC industry. Mad Men. Whenever you go out to the West Coast, I spend most of my time out the West Coast. We do have some East Coast investments, portfolio companies, but I would say 70% of our portfolio is on the West Coast. And the VCs out there are kings. I mean, they're royalty walking around. Every time you go to any sort of event, there's Teslas all over the place. You can't get around it. It's just the high energy of that sort of environment where it's been successful tech businesses. They're always looking to VCs. People are looking to switch jobs to find the next hot startup that they can go join. So there's a lot of buzz out there. You don't have that same sort of experience in smaller venture communities. New York is another one where it's hot, but there you've got so many other sort of distractions or businesses to work with that you don't have that same sort of tech buzz. Clearly, I know all the venture people in that industry, and when we get together, we talk about these things, but it's not like, there's just 100 other people that are famous or have that kind of buzz. But out in the Bay Area, the technology is the kind of the elite class out there. So what I want to talk about, this is just basically where the industry is going right now. And I've got kind of the annual chart and then a quarterly chart. It looks like the quarter is falling off on 2002 to 2012. Really, that's the same. That's trending about flat. That's a huge come down, though, from the prior 5 years. In 2000, 2005, there was twice as much capital, almost 3 times as much capital going into startups, and you got, what, 3,600 deals? There was 8,000 deals. There was a ton of money going into venture capital, and since then, I can't walk away to it. Oops.
There's in the middle.
Middle. So that's showing this trend is basically flat. You can look at the quarterly numbers here, and it's picking up a little bit. But I want you to remember the amount of capital that's going out. Basically, it's good business. There's still deal activity happening. The other side of the industry, though, is having exits, and there's good liquidity. Back here, you can see the year before this, it was awful. There were no IPOs for over 18 months. There were hardly any M&A exits. There's basically companies getting shut down or trying to make it through the desert of no liquidity. Since that time, obviously, things have picked up. You've got a nice trend of both M&A and IPOs. Still predominantly, the exits for startups is through M&A. They get bought by some other company. I should have grabbed a chart talking about valuations. Valuations are generally very flat. They've come down a little bit depending on the later stage valuations. So your B and C stage stuff has come down, but it's generally flat for other sectors. So startup or seed and A stage are basically flat valuations over the past 3 years. The bad news is The Walking Dead, and that refers to zombies. And there's 2 aspects of the zombies. One is the returns for venture capital have been awful for the past 10 years. So when you look at these sectors, right, and this is a little bit old, but the data hasn't changed that much. You can see, compared to Dow Jones, the NASDAQ, or the S&P, over quarterly returns, over the past year, the markets are still on a run. And over the past 10 years, you're better off investing in public equities than you are in venture capital. There's a couple of reasons that are driving that. Mostly that too much money flowed in and you had too many guys trying to make investments. The other side of it is, though, if you recall, the amount of capital going out was in the mid-20s, the high 20s. There's less capital going in. That means there's going to be a shortage of capital and funds to disperse through VCs. It's going to, you can't have 30 million going out without it being replenished, and it's not being replenished. Back again 5 years ago, ton of money going in. Too much money going into the sector, overinvestment, returns got lousy, money's starting to come back out. What that means, though, is there's a bunch of zombie VC firms. They're still out there in name, they still have a portfolio, they're not deploying any new capital, they're letting all the partners go, and there's a ton of VCs looking for a new firm to go to. And so there's a bunch of people that have done investments, they're not doing investments anymore. The top tier firms are still raising funds, the top 10 firms. And you can see it, they're billion-dollar firms in terms of raised, and that's why there's still money going into the sector, but it's not, as a general thesis, raising more money. There's also this thing called Series A crunch. The number of early stage seed companies has been on a tear for a while, and you can see in the past 2 years it's really shot up. And that's got guys, hey, I got money, I can go finance a company, or I have successful money, and money's going into seed stage deals. You also have a bunch of incubators that are creating new companies. Problem is, at some point, they need to raise more money. And what you're seeing here on this lower chart is there's a big gap between the number of companies that are raising Series A and the number of companies that have got seed financing. So they get enough money to start their business, grow it a little bit, and they run into a wall because they can't raise any more capital. There's a couple of issues that are driving that. One is the valuations on some of these early stage deals start to get competitive. You've got a bunch of seed guys and chases money. Hey, I can get this business. They put it in, they get it too high a valuation. The next guy doesn't want to have to force a cram down to lower that valuation, so the entrepreneur's stuck, can't raise money, they run out of steam. There's also competition. As we said, you've got those VCs there's fewer VCs out there deploying capital. That means they have less money to deploy at A round. You can only do so many deals, and so that means there's not enough attention spent at that. So there's a big drop-off. This is what you hear as Series A crunch, zombie. So you have the zombie VC firms that are out there in name. You got zombie startups that they're out there, but they can't raise capital. They're basically walking dead. So Breaking Bad. This is people getting into a business that maybe they don't know too much about, but can excel at it. And we're talking about corporate venture capital. Part of the gap that's being filled from the financial VCs is being met now by corporate venture capital, and there's a big trend, which you don't see as much on this chart because don't go far enough back, but a big trend in increasing the amount of corporate venture capitalists in it. This chart actually shows that the number of corporate VCs participating in making investments has increased, and over the past 2 years, I can't tell you the number of new firms that have started doing investments. On the one hand, I think it's a positive trend. I think that it helps drive innovation for those firms. On the other side, there's an old saying, it takes 20 million to really know what you're doing, to lose 20 million before you really know what you're doing in venture capital. So these corporates are going to be spending money and not getting good returns on it. And so they'll probably go in, and then when the CFO finds out they blew 20 million, they'll get back out because they won't be able to get the capital to continue their programs. The good news about corporate venture capital, though, is that it increases the returns of startups. So having a corporate venture capital participating in a financing at some stage of the business actually increases the likelihood of success or return for the startup. Same thing is true for the corporate venture capitalists that actually participate. I don't have a chart here that shows it, but there's research that shows that corporates that do have an active venture capital program have higher returns than their competitors that do not have programs. And actually what it says is the more corporate venture capital that you do, the higher the returns. So I've used that argument with our CFO. He wasn't impressed by it. So I've got my budget. But the fact is, corporate venture capital does create value for the host firms, and it does create value for the startups that they're investing in. The interesting thing is that the financial VCs view them still, corporate VCs, as somewhat competitive or somewhat new to the industry. So there's kind of a friction with some of the financial VCs in participating, having a corporate VC participate in the financing. I've been doing this long enough. I have a great relationship with a bunch of strategics. They're actually our financial VCs. They call me up to bring me into deals now because they know that we're a reliable investor. That they know that we bring value add to our deals. So Verizon is, over the past 10 years, has, through CapEx, through M&A, has deployed more capital than any company in the world. And in particular, I mean, we're way over the charts now. We just announced a $130 billion acquisition of the other half of the Verizon Wireless JV with Vodafone. So by far, we're spending more capital than any company. On investing in startups, we spent less than $100 million over the past 10 years. So when I say that we help drive innovation, we do, but it's very small. It's infinitesimal, the amount of capital we spend versus what the corporation spends in capital. And so that's why, yes, I'm a successful corporate VC, but let's keep it in perspective. It's not even a rounding error on the results for Verizon. So these are some of our portfolio companies. Actually, we've made 4 more since this time, so that aren't on there, which we haven't announced. A variety of sectors. I'm not going to go into identify all of them. My guess is that most of them, let me think if there's any that they're not really consumer brands. Well, that's just it. We don't invest in a lot of consumer brands, or the ones we didn't achieve escape velocity. I would say when we look retrospectively over the type of investments we've had, 75% of them are wireless related, 25 are wireline or enterprise related. They come into really 6 different sectors: m-commerce and digital marketing, networking hardware and software, over-the-top applications and platforms. More importantly, platforms that serve applications, location-based services, connected home, and machine-to-machine. This matrix is actually pretty famous by HBR that they've published or not HBR, but a Harvard professor that tried to segment how corporates look at their investments. And so the matrix here is tying to the operational capability of the company, whether it's really a tight fit where it's linked in closely to the core capability in operating. And then over here is whether it's a strategic or opportunistic investment. So that gives you this matrix of 4 passive investments, where obviously we don't do that. The core of what we're investing is trying to find investments that tie tightly to our operating capability and are consistent with our core strategy. The majority of the other investments by dollar amount, you can't see the dollar amounts here, but are over here on opportunistic ones. Again, we're looking for stuff that's consistent with our operating capability and much more perspective further out in terms of where our strategy is at. And then the remainder of the investments, are in this leading sector. Over 100 million capital deployed. We've had a successful track record. There's 2 investment professionals prior to this year. We're ramping the team up to 5, and we're going to try and spend 100 million a year. So what sort of are the typical deals that we're looking at? We're not doing seed deals right now. We still occasionally look at them, but to be a successful seed investor, you need to deploy a lot of capital, looking at a lot of deals to have those few returns come through. We're much more selective, so it makes more sense for us to focus on B and C. We're targeting about 15 to 20% ownership through our investment. One of the big questions we always get is, what sort of, do we need to extract a special relationship or exit? And we don't look at those sort of tie-ups to our portfolio companies, because that, as other investors hate that because it minimizes the upside for a startup when you want to be able to invest in it. So what that means is we won't say that we're going to get a right of first refusal on buying out the company. We don't take board seats for the most part. And that's because you get into a conflict of being a fiduciary on the board seat, and it can get in conflict with your role as a strategic VC and working with the company operating-wise. It's much easier to have a board observer right where you don't have the fiduciary. You have significant influence on the board decisions, but you're not tied up worrying about kind of the legality of it. You can also secure your investor rights through your shareholder rights to protect us. And what we're looking to do is basically invest in companies that create value for our customers or enhance our networks or services. That's it in a nutshell, but what really we have to do is find investments that we can convince our investment committee, which is the chief strategy officer, the chief financial officer, and the chief technology officer. We have to convince that investment committee of 3 that these are strategic deals. So, we might think it's a really cool company, but if we haven't convinced our investment committee that it's a cool company and that we should be deploying capital in it, we don't get it approved. So it's a tough world out there, but there's a lot of myths about how VCs work and how they approach the business. So you don't need to raise capital from VCs. There's, in particular, there's crowdsourcing, and there's other and incubators that will give you capital, friends and family. That's where you should be focusing on raising capital and not going to pitch a VC for money. Again, we just talked about how that segment is reducing. If you're going to go pitch a VC, you better make sure that it's the sort of startup that he wants to hear or she wants to hear about. VCs don't actually risk a lot of their own money. They get when they raise a fund, they get a carried interest on any upside of the deals, but they get a management fee that basically covers their operating costs. So in the VCs that have done it a few times and raised multiple funds, they're getting $500,000 just in management fees personally to do investments before they actually deploy a single dollar and see any of that money coming back. They do risk other people's capital, though, to be able to get the sort of returns that they want to look for. VCs are all different. There's a couple of VCs that are high touch, have lots of support groups. Google Ventures from the corporate side, Andreessen Horowitz. Again, these are West Coast firms. On the East Coast, I'd say Lara Ventures as a seed investor have strong support teams that help the entrepreneurs fill out the rest of the team, add value add. Other guys just write checks. As a strategic investor, the value add I'm bringing is helping navigate Verizon and how you need to work with us, and making sure that we can scale up, that the startup can scale up appropriately for working with Verizon. It's a big company, and we do this embrace when we start working with the company. So, imagine a meeting like this where I'm the entrepreneur and you're all Verizon employees trying to help tell this entrepreneur what we need to do. It just chokes them. So I need to help manage that relationship, and that's the value add that we bring, plus insight into the sector that they're not going to get from their investors. Already talked about 4. The returns for VCs are not that good over the past 10 years. The top 10, 20 firms are generating spectacular returns. But the point is, the smaller the VCs below $250 million in terms of capital raise are actually generating better returns than VCs at the higher end. And that's what we saw at the beginning of the decade. You had so many people entering the sector. There was too many people making investments. VC doesn't scale. It needs to stay smaller and closer to the startups and the communities, the venture communities that they're engaged with, and deploy capital selectively. And finally, VCs are innovators. They like investing in innovative companies, but the venture capital model hasn't changed in 30 years. It's a guy that raises money from a limited partner, gets his management fee, gets his carried interest, and at pretty much flat rates, and that's still going on. There's a lot of pushback. There was a study by the Kaufman Institute, which has a bunch of investments on its own and does research for venture capital, that basically said the model's got to change. You need to come up with a different way to structure the way that VCs are compensated and raise capital. So on the other side, though, that was kind of the negative side. We're going to talk about the Big Bang Theory. Has to do with the unicorns out there, and this is some recent report that was out, or blog article, and some dialogue amongst VCs about the billion-dollar exits. So these are the companies, unicorns are the ones that have made worth $1 billion that have been invested over the past 10 years. And so what you're looking at, it depends on how you want to kind of parse it, but say about between 4 and 10 companies a year that get invested in over some period of time will hit $1 billion or more exit. And that's about, over the past 10 years, it's anywhere between 40 and, again, how you want to cut it, about 120 companies. And these are generally, if we narrow the data set, it's down to US-based companies and ones that are focused on technology, excluding healthcare and all those other consumer companies. Consumer-oriented companies have actually created more value. So a Facebook creates more value in that sector than the enterprise ones. But enterprise takes less capital to get started, scales faster, and generates better returns. So VCs like making investments. They also have generally a better identified business model, and VCs love making those sort of investments. I don't know if anyone's interested. Those are the sector: consumer, e-commerce, audience, software service, enterprise service. Big pivot refers to, we go out there and we find that the model doesn't work. And so we got to make a huge change to the business to try and take another approach. Big pivots only work when you have really good teams and you get lucky. So Groupon, this is the best example over the past 10 years of success. They didn't start out doing directed marketing towards companies. I can't even remember now what sector they were after. And they realized it didn't work, gave this a shot, and it paid off for them. 7.5 years to liquidity event, that's an exit. So the first time that capital goes in, you're looking at 7 years for these companies before they had a big exit and created that sort of value. And actually, 7 is coming down from where it was. The average for liquidity events for any venture capital has been, again, we're coming back from the desert, but it was 8 years. So 8 years for us to put money in before we saw our capital coming back out. So this expectation that it's, putting money in and flip it in 3 years, that's not the way VCs work. San Francisco, not Silicon Valley, you're looking at about probably 30% or San Francisco, probably 25% Silicon Valley, 15% New York, and then Boston's a little bit just behind New York in terms of where the successful ones were. Again, the misconception is you got to be, in fact, there was some VCs said that we won't invest in anyone that's over 30. That's not really the case. Successful, huge exits have happened with older teams. And what they found is teams that have gone through it more than once have a better chance of having a big exit, and if they've worked together in the past. It's, the teams are the most important thing that we're investing in when we look at deals. You got to make sure that they can work together and know how to scale up the business. And a little diversity amongst the founders. There's only 2 women that were founders out of all those companies. Neither of them were CEOs. The rest were men. There's a generally pretty good racial diversity because you have a lot of immigrants coming in from making those investments or working, creating startups. Okay, that was it. Now it's just questions.
On that a little bit, and also what are you not interested in? What are the areas that are completely off?
Okay, so the question is what areas we're investing in and which areas are we not interested in? So let me start with the things that we're not interested in. Again, if it's very early stage, throw back in the ocean, let it grow up, and we'll see if it is of interest later. And also, we're not interested in companies necessarily that just utilize our services. The customers of Verizon that want to come and say, hey, we need capital to grow. that's not particularly interesting. And then the final sector, I really like it a lot. There's metering companies and all these other really interesting companies. They're just not going to get big enough to make it interesting for me to spend time and invest in it. I'd actually like to try and come up with a way that we could deploy capital in those sectors, but we're not pursuing that sort of stuff right now. So the mega themes, mobile advertising, the kind of the ad networks are pretty well done. But if you look to how web advertising developed, there were all these supporting companies that were created afterwards to help optimize ad delivery. When the transition to mobile came, a lot of the technology doesn't apply, and particularly cookies are ineffective on mobile advertising. So demand-side platforms, conversion tools, real-time bidding engines. There's a lot of opportunity in that space, and we've made 3 investments this year in that sector. We'll probably make a couple of more over the next 12 months to kind of just circle out. We don't know if we're going to hit or not, but it's back to that's a general thesis area we think is interesting, and we've hit back to some really great teams. There's a lot of talk within the networking circles of a technology called software-defined networking. It's where you separate the data plane from the control plane so that when you buy a hardware router, that stuff is combined. What we're doing is separating that so you can use general-purpose computing infrastructure for the control plane, and the data plane gets on these very low-cost switching devices. And so we've got frankly, one of the best investments in the sector right now that's performing really well. And we're looking at other ways to fill that out. And there's a corollary to this sector called network function virtualization. Again, it's a really interesting sector. And then within platform as service, we at Verizon acquired a company 3 years ago, Terramark, that does hosting. And we also bought a company called CloudSwitch, which helps migrate enterprise applications in the hybrid cloud. So it operates both at the corporate data center and in our cloud. And we launched new products this year in that sector. I'm going to be making an investment in a platform as a service as part of that. So you got infrastructure, platforms, and then you have vertical services within that. Some of that stuff is this whole big data area. I think that's too broad a term to really be specific about what we're looking at. So there's particular verticals where we think analysis and tools are really useful. So we're going to be making some investments the next. Well, healthcare is a little bit tricky. I mean, actually, the biggest vertical for Verizon Enterprise is healthcare, but it's mostly pipes, to hospitals and service. So what we're doing on the services side is very limited. We just announced a new product, though, a secure healthcare cloud to help manage that sort of stuff. The problem is we don't have a lot of subject matter experts that have deep domain expertise on healthcare, so it makes it tricky for me in terms of comparing those sort of deals to ones in other sectors. So if we have a partner that comes in with us that can help say, hey, this is a good deal and we think you could add value to it, then we'll get interested in it. But it's one area where we may consider doing some indirect investments, so deploying capital in a couple of VCs to help generate deal flow for us, give us someone to bounce ideas off. But it's really tough for us to go deep in that sector. Yep.
How do you think crowdfunding and the Jobs Act will affect your business and VC in general? So
the crowdfunding and Jobs Act, with respect to corporate venture capital, I think what's going to happen is you're going to have more of this Series A crunch, frankly, that it'll create a lot of new opportunities, and that'll make it easier for companies to start up. But it's, starting is easy, finishing is hard. So that's going to be a problem longer term. So I think, we'll have more things to look at, but, we've got to be selective about the sort of deals we want. I think the problem is there's not enough capital at the middle stage. So I actually think there's an opportunity for some new VC firms to be created that are focused on A and B, but I think they got to be, small, focused on a particular sector and a geographic area. Okay.
So I've done the whole VC thing, and oftentimes the venture capitalists will have like a minimum criteria for an investment. Like I have this mobile company I went for VC with, and it was like, oh, you have to be making $10 million a year or $5 million a year, and show it's sustained over 3 or 4 quarters. Do you have like a criteria?
No, not that way. I mean, what we look at, we do spend a lot of time. I'm a finance guy, and I spend a lot of time looking at the business model. I want to make sure there is one, right? And so we've got a couple of, let's stick it up against the wall and see if it works, investments, but they're very limited amount of capital. We're generally looking at companies that where we think there's a reliable business model. So what I'm really much more focused at is what's the cash burn? How much investment am I putting in? How much runway does it give them to get to the curve where the business can start taking off? Because I know it's going to take time to get there, but I do not want to put money in and have to put more money in within the single calendar year. That's kind of our biggest criteria. I just don't want to waste time there. But in terms of exit expectations or the amount of revenue it's got to generate, I don't. It's you're just kind of guessing for the most part.
Stack, you say any service that would go Verizon services, you guys would be like cloud,
Cloud switch is so the question is specifically anything that helps promote our enterprise services or our hosting platform in general. Are we interested in that? I think as an investment thesis or a business relationship, as an investment thesis, yes, if it helps drive create more opportunity for our business and help us get increased sales, those are always more interesting than things that just drive cost out of the business. But it always comes down to diligence. Is it going to fit well with us? Is it something that they're going to be doing that it's going to overlap with their own product development? I don't know. But as a general thesis, yeah, I think we are interested in things that increase sales.
What's the best way to approach Verizon Ventures, number one? Because years ago, Cellfire raised $30 million off of mobile coupon innovation. I wanted to reward inventing it, and I approached Verizon Supplier Relations. In 2002, it was almost impossible to get through the doors to get a meeting. When Sam Morris invented the telegraph in the 1830s, it was ignored. I'm just wondering, I know there's a lot of ways to get with companies. What's the best way to approach Verizon? Is it hard to get a meeting? And also, does Verizon ever consider, rather than people who want to grow a business, someone who just wants to license an innovation or a patent? Is there an opportunity?
So I don't deal with any licensing or patenting issues. I try to avoid. In fact, if people send me stuff with patenting information in it, I don't even read it, because all it does is create liability for Verizon. But as soon as and so that's the first thing. If you're going to go talk to a VC, especially a corporate VC, don't mention that you've got a patent or that you're filing patents. You can talk to that later on, but if it's part of the headlines, they just are absolutely, there's more liability for them than upside in evaluating.
They won't even meet with you unless you have a patent.
Well, then I can only speak from my experience then, and having had the straps on my back from our legal team about how we approach it. So I'll generally put an unsolicited approach. It's hard to get any traction with anybody when it's that way, and it's really in fact, we used to have a website, we turned it off because we weren't getting quality deal flow there, and it was just burning time for us. And so, and the way we and other VCs look at it is, it's basically a entry-level threshold for reasonable entrepreneurs. Can they figure out how to get into us with it through a referral that makes sense? And so if it's just a cold call to us, it's really, and the new cold call is LinkedIn. That's still not an effective method for engaging with us. And so the approach is finding someone that either just through a network to come in and get us a reasonable referral.
Was this created as a Verizon to make more revenue or having jobs?
Which, I'm sorry.
Okay. Is that a sorry.
Rather than the school from Sing Labs. I want to ask you a question from the perspective of stockholders of Verizon. Do you have, at any time coming to these meetings, a list of technical issues Verizon is looking to solve and could solve from these lines? This is question number one, and I have a follow-up.
Okay, so the question is, when I come to these meetings in particular, Verizon is a huge company. So do we have a laundry list of things that need to get solved? And Verizon has a ton of issues that need to get solved, and it's not necessarily the way I go to approach it, because I think I'm much more interested as an investor in finding opportunities to create growth for Verizon than simply in solving a technical or business issue. Occasionally we get asked by the business units to go through our networks to see if there's something out there, but I don't come looking for those sort of solutions when I go out to meet with companies.
I'm trying to answer the question of growth. Do you give equal chance for equal opportunity for small companies to compete with big companies when making acquisitions and getting the top-notch technology, or you just assume like we don't need to do
So the question was, do we give equal opportunity to small companies to big companies? You said acquisitions.
no, purchases? Like
Purchasing, okay. So the answer is yes. I've had startups that I was stunned that Verizon was actually turning to. There are significant issues and hurdles, though, of a small company providing services to a large company. One of my best portfolio companies right now performing is this SDN company. Basically screwed the pooch in terms of providing value to us. The network team was all over them because they were not executing. We got rid of the CEO. I was part of that decision making to say he was not achieving it. Basically the founder came back from the board to take over the CEO role. They've got their execution back online, and now it's a great success. They're a highly valued supplier, but a small company like they are lucky they got a second chance. I had another startup. It was one of my first successful exits. It was providing a navigation service to Verizon. They had a service outage because Verizon has extremely high standards for wireless networking. 5 nines in terms. It's probably 4 nines for this application. We're talking they were out for 2 hours at night over the weekend. And Verizon was ready to kick him out. And I said, well, let's figure out if there's a solution here. Actually, they weren't ready to kick him out. There was a penalty. And this is a startup that, we put $20 million in capital in, and now they're going to take $1 million out as a penalty. I'm like, well, maybe we can negotiate something here. And we worked to them, instead of taking the money out of the business, to put it back into redundant capability so that they were providing better service to Verizon, and we weren't crippling the company by taking capital, capital out of the company.
This doesn't have to be
As to companies that Verizon has invested in or is investing in here, to what extent do they wield over them sort of the idea that those companies can't provide their services or products or whatever to competitors?
None at all. So the question is, do we ask to constrain our portfolio companies away from competitors? And absolutely not at all. In certain cases, we actually need the whole carrier ecosystem to make them successful. When we look at investments, though, we have co-invested with other carriers. We want to make sure that our investment reflects the benefit that Verizon brings to a company. So I will look to get additional upside through warrants, performance-based warrants that allow us to out-execute our competitors. But we absolutely do not constrain our startups. VCs don't want partners like that. They don't want you to go in saying you've cut off 2/3 of the market.
You measure on your return on investment, or you measure on the strategic fit, or you have basically guidelines that you repeat down?
So the question is how I'm measured. So we are measured on financial performance. We've out-returned, though it's a low bar, we've out-returned the financial VCs, or the top. I think we're above the 85th percentile in terms of returns. But the biggest issue we've had, and I've talked to lots of corporates, is how do you measure strategic value? And again, if someone's looking at venture research, I'd love to have the answer there, but I've talked to a lot of academics about it. It's impossible to do. Not impossible, but it's hard. So at the end of the day, what we get tracked on is the value add that we provide to the business units, and so there's a feedback mechanism that they provide to my bosses about how the value that I'm providing to them.
So it's a lot more than just a return.
It's not just financial return. Yeah, I don't know about a lot more.
Dan, question for you. Thinking as a founder of a company
Jersey. I'm just wondering how much, your first statement hit me about the fact that you spend most of your time out of the state. So how did we get your attention here in New Jersey and get more investment into startups here in this state? And, you know, I did the Sand Hill Road, and I was basically, you're from Jersey, we don't invest in New Jersey companies. We're trying to build a community here. I'm just looking, not necessarily from Verizon perspective, but you did a really good viewpoint. What do we have to do to get that kind of attention? I mean, the guy next to me's got a Tesla.
Well, I don't, you know, believe me, I aspire to a Tesla too, but you need the superchargers all up and down, and that's a problem. So the question was, you know, how do we build a better community? Well, first of
Geography really.
and frankly, I think you got to lean on what's in New York and the few venture capitalists are here. I mean, you know, building a successful business takes, you know, a really solid team. The VC is bringing capital and is basically a coach or manager of it. There aren't as many coaches, that's part of it. But the same thing, the team resource, it's not as liquid as in terms of, or fungible as you can find out on the West Coast. I mean, that's a blessing and a curse because it raises the cost of finding employees out there, but you know you can find somebody. Whereas and we made the mistake of investing in this company in North Carolina, and it was even worse. There's no one we can get to even take an interest in it because they're not close. And I think that's why you've got to try and drag the New Yorkers out here that have the money and have the time, and it's not a big travel issue. That said, my colleague again, we had two of us, but we're expanding the team. He actually moved out to the West Coast, so I'm spending more time in New York mostly, but more time on the East Coast.
Are we doomed in New Jersey?
I don't think you're doomed, but it's got to be, right, because I think healthcare is going to, again, technology investments.
But they're all leaving. Every farm is out of here.
Well, then, I think but I think they're still looking at people that don't want to leave and have the ability to start those businesses here, can find the wet labs, can find the people. Those people are still here, and so you can create those sort of startups. I think it's got to be, you got to create, the businesses that are being created have to be of interest to the VCs, and so I've looked at, and I'm actually in diligence with one company that's based just up on Route 10, so it's still possible. But all those telecom companies,
Verizon's headquarters is in New Jersey.
it is in New Jersey, but all those telecom startups that used to be with ALU and all that, they're not here. They're not here.
And that's why we organize, this meetup, why we're creating workspaces. We're trying to create a community so that it makes it attractive for Verizon to invest back here in the state. That's why we're here. So, it's thanks to you for coming out and making it happen.
Are you good?
I'll answer more questions. I'm
Got one or
okay.
two more,
If people
maybe?
don't want.
Yeah. They'll have plenty.
Okay.
How do you bring back the innovation inside Verizon?
So that's a trick. I think that's actually, I think the hardest part about it. And so there's a couple of ways. When we go to make an investment, I'm working with the business unit up front to understand how this plugs in. And actually our investing criteria has changed over the past 18 months. It used to be, I need to have a business unit sponsor. I don't need that business unit sponsor anymore, but I want to know what they think about it. And so what I've been asked to do is get much further ahead of the business unit, but in the past it was, an 18-month time frame to try and pull them in. And so I essentially become a business development resource for the company, figuring out how to navigate Verizon, how to get, who they should be talking to, getting them in front of the decision makers and the people that are interested in deploying that sort of technology. And then, after we get that initial sale, then I'm trying to find the next one after that. So,
Let's do one more.
So thank you very much for coming out here.
Okay.
And taking the risk.
No
with
problem.
Startups. Number one. Number two, state of New Jersey. So how does a corporate VC, Verizon, see how the state of New Jersey is supporting innovation and technology?
yeah, I mean,
Do you think
as a corporate VC, the governments have don't factor in our decision-making whatsoever. And so, we have 4 Israeli-based portfolio companies. We have 2 in Canada. We're going to chase where the good deals are, and that's all we're interested in.
How about the Bloomberg effect in New York City? I mean,
You know, I think that's oversold, how much impact he actually had on the venture community. I think what happened was you had some successful startups that with some VCs that really came down from Boston that migrated down there. I mean, the most successful VC in the New York area is actually a Boston one, right? And then they created, some new funds got created. That's when, capital started going in. You had some successful entrepreneurs that went out for another round. That's how that community started. It's a snowball effect.
And I mean, I've been in New Jersey for 45 years, so I've seen the startup community. I totally agree with you. It's not the state that's going to create innovation. It's really meetups and entrepreneurs that are going to start the companies and then eventually end up at a Verizon VC pitch. So it's all, it has to be organic and not so much government motivated.
Yeah, I mean, I think that's why when you look at the early stage stuff, that's why I think crowdsourcing is worth doing it, but you've got even fewer, tech knowledgeable. I mean, I think that's the biggest thing we have to do is, or the biggest recommendation to have an entrepreneur is you got to be technical. So I don't know, I forget the guy's name that did, he's not a technical guy. You need to get technical because otherwise you're not understanding how your business is going to operate. And I think, teaching people coding is just fundamental of understanding, because software is so important to any business that they need to understand how to deliver. And guess what? It's a great skill if you're any good at it. So, yeah, I don't disagree. No second questions.